Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We talk every week about the reality of running property businesses. Stuart runs a portfolio of co-living properties with a six-figure turnover.
And Simon owns Buy-to-Lets and created Patma, a leading portfolio management software system and a source of property market insights.
And Simon Glastonbury is an independent mortgage broker with 25 years experience providing mortgages, bridging and development finance for home buyers and investors. Don't forget, you can join our email BOP tribe following the link in the show notes. And at the end of this episode, I just want to let you know that we will be covering a sort of quick fire round of current mortgage interest rates. So do make sure you listen to the end for that. But to start with, I just want to point out that we are recording on the 30th of June, just in case anything changes in the next few days before this gets released. And last week, the Bank of England increased the bank rate again, or the base rate, I should say. And that probably had some effect on the mortgage market and the mortgage world. So hence, Simon is here to tell us all about it. So what has been changing?
Well, hello again, guys. Good to catch up again. It's certainly interesting times again with interest rates, with the bank, the expected increase in Bank of England rates, where previously we were talking about as soon as they've increased, the banks had already worked out that they factored in the increases. Fixed rates were pretty much staying where they were, and wasn't really a huge amount of change. That's changed. It's definitely different now. Banks are increasing fixed rates up, certainly in the residential world, not so much in the buy-to-let, the limited company buy-to-let, HMO sort of sector, but residential world, they've gone up, and I would say significantly in some areas. So yeah, a concern. But you can see the banks are concerned about what's happening moving forward. It sort of takes me on to rate withdrawals, which is a key factor in a broker's life at the moment. It's certainly in my life.
Sounds like you've been addicted to rates and you're just now getting the withdrawal symptoms on that. But I'm guessing we're not talking about that.
No, we're not. No, it's certainly not something I am addicted to, Stuart, but it feels like it on a day-to-day basis. I do feel, I guess, but
every 30 seconds you have to click refresh to check the latest rate. Yeah.
It nearly is like that, because banks they're withdrawing rates at rapidly. So, I mean, they can give you literally an hour at the end of the day to get an application off and up and submitted. And of course, the brokers of the world, when different brokers use different systems, and of course, some will pass it over to administrator and they will do them all at the end of the day, or all sorts of different systems they have. So that throws that out completely. You have to get on these things. Otherwise, client loses a rate and it's going up.
So just to clarify on that then, Simon, with rates being changed and withdrawn quite quickly, and what you're talking about there in terms of getting the offer out to your client, i.e. the person that wants the mortgage, if they get an offer, and again, I don't know, you'll give us the technical term, so whether that's an agreement in principle or an offer, once they've got that, does that the bank has to commit to that rate for a certain period of time?
Yes. In simple terms, what will happen, as soon as the agreement in principle doesn't hold the rate, that's because 99% of the lenders, you don't choose rate at decision in principle stage. Okay. Decision in principle will go on in another time, but decision in principles are very different from what they were years ago. So they're very simple credit check, credit scores. That's it. You don't choose rate. It's when you submit the application at that stage, you lock in the rate certainly lock in the rate until you get the offer. There are caveats there that if it takes too long, it drags on. Application changes, you won't get that. But let's just use a very standard application. As soon as the broker puts in the application, the rate is locked in. You will then that will then get you through underwriting, valuation, up until the mortgage offer letter. That is then where you've got you are certain that you have that. So from a broker point of view, what we want to do is we want to get certainly at the moment, we want to get the applications off as soon as possible. Whereas probably over the last sort of year or so, it hasn't been such a necessity. We're sort of holding off and say, well, okay, well, if you want to wait, you want to think about it, which has been the case for years. But think about it, and people they're still in that mindset. Yeah, okay, well, I'll think about it. I'll go away. I'll speak to the husband. I'll speak to the wife. We'll discuss it and come back. Now it's a case of, look, get this in, make a decision now, because it might not be here tomorrow. And the banks, they haven't got any recourse. It's you either have it, and if it's not there tomorrow, tough. And that's the issue we're having at the moment.
And are you seeing any pattern in terms of the rate withdrawals, in terms of like as in rates under a certain threshold, or is it just, they're just pulling products to mitigate any loss of income for the bank, basically?
Correct. Yeah. I mean, they're probably not going to say that, you would think. But I mean, common sense would say that if a particular lender has a huge amount, twice as much business in one day on a particular product than they're used to, they're going to pull the rate because they know from a broker side, we'll all be going for that rate. And then that then affects, and it has a knock-on effect, which you guys have both experienced, which is service. Because if you're doing, we've mentioned this before, but one of the, if they're usually taking in, one of the big 5-6 banks will usually take in roughly 1,000, 1,500 applications a day. If that goes up to 2,000 or 3,000, and they then have to process those, if that's happening daily for a week, for example, all of a sudden their admin staff are swamped, and the service then suffers. And then the applicant then really unhappy because it's not taking a week or 2 weeks to get the valuation out. It's taking 3 or 4. It's not taking a couple of days to look at documentation. It's taking a week, 2 weeks. That's really frustrating. So they're on it, but equally on the flip side of that, I don't think the banks want to be caught short with rate and income.
Is it wrong of me that I chuckle inside when you say the word service in relation to banks?
I thought there was a glint in your eye as soon as you say service. It amazzes me, mortgage lender service, because one lender you can send some documentation up to it, and the underwriter will get back to you that day. And you go, that's brilliant. And then you can speak to them. But they're so, lenders are still antiquated in some of the ways. You'll go up, some we can still not speak to the underwriter. You can still don't have any direct contact with the case handler. So it's going through 3 different sets of hands before it gets there. Infuriating. You would think you would look at, it's like any business, isn't it? You look at someone, what works? Oh, that works really well. Why don't we use that system? There you go. I've solved the whole mortgage lending admin problem in one go.
So tied into the service, but not entirely service. Assuming you do actually manage to get applications in before banks withdraw their rates, how are you finding the sort of ongoing process at the moment? Are banks sort of accepting the mortgages once they've been submitted? Are they throwing up lots of roadblocks and actually ending up rejecting things? And how is that process looking these days?
I would say it's wide ranging, really is. I've had a couple of mortgage offers within 24 hours of submitting the application. So automated valuation, automated income verification, automated identification offer there. It has to be a relatively low loan to value, but you think that's brilliant. That's service. Surely. And again, we could all sit here and say, look, there's a property of 500,000. You only want to borrow 200 grand. The person's been at a job for 15 years, PAYE. Some of the lenders can cross-reference these things anyway. Automated ID checks are very easy to come by these days. And you go, well, how many more checks do you really need to make on that? They've got a huge amount of equity in the property, so it kind of makes sense. Then on the flip side of that, you have some real issues coming in. Buy to let, and certainly the buy to let market, it seems to be lenders are asking a lot more questions. One particular issue, questions we've talked about off air with fire risk assessment reports and external wall reports, which are a real headache because although it's a requirement, if you have a management, I mean, a lot of people don't know, apart from paying into a management company, probably don't know or speak to them, or an awful lot of people I experience don't speak to the management company. They're quite often directors who used to live in the block. So trying to get hold of them is really difficult. And then have they got the correct reports? Is that report acceptable to the lender? We're being tripped up quite a bit with that at the moment. So, and that then just drags the whole process on and on, because trying to get hold of people can be really difficult.
Obviously, we've got some direct experience with external wall surveys and that kind of thing. But you mentioned, rates. So we've talked about rate withdrawals, and something also you mentioned before we hit the record button, Simon G, was swap rates and what your sort of understanding is of what's happening there at the moment. So I thought before we lead into current mortgage rates, which is probably of most interest to people, is what your current understanding there of swap rates and how that's impacting mortgage world.
Yeah, swap rates are interesting. Something most people, use the term of phrase, the man on the street, would probably not know an awful lot about previously. Well, certainly since the last sort of few months, and it's
a bit like everyone becoming a statistician during the COVID period, and now everyone knows about swap rates because interest rates are going up, and it's all about fixed rates, and if you need fixed rates, then you come to swap rates. So yeah, I think you're wrong there. A man on the street definitely knows what swap rates are now. I'm sure they fully understand them as well.
Absolutely. Well, I'm certainly not an expert, but we do get given the information all the time. And in basic terms, it's how banks are borrowing money and what they're paying for the money themselves. So if you're looking at swap rates from a year ago, 2-year swap rates was at 2.8. At the moment is at 5.7. So that's literally June last year to June this year. Huge difference. So huge difference. Now banks have to pass that on. There isn't any way around that. They don't have this magic pot of money that they can just lend out at a different rate to everybody else, which is something some of my clients think I'm able to do on occasions if they ask nicely. Unfortunately, haven't got that just yet. But if you can see that, and it's certainly something to now pay attention to, and it is good that these things are being made aware of. They are in the papers. They're being made in the media. They're all over the place because it's a bit of a buzzword at the moment, swap rates. So people are getting their head around them. And if you do get your head around them, you can then see where the rates are going and then the projections of what they have over the coming years. And that then leads on slightly to, well, what are people asking for at the moment? Quite simply, 2-year rates. I haven't really looked at 2-year rates very much. I would say probably in the last 7 or 8 years, pretty much everybody. There's always going to be an occasion when someone's going to be a quick move, or they want something without early redemption penalties, or there's something quirky there. But generally speaking, for a residential or a buy-to-let purchase, remortgage, it was 5-year rates. Because 5-year rates were very good, and it made sense. Now it's the thinking from the public at least, is that rates are going to come down in a couple of years, and it will take the risk. The 2-year rates at the moment, 2-year fixed rates, are higher. I would say on average, and this is just generalization, about 0.5% higher than the 5-year rate. So it is a risk. Is what happens if they don't come down? What happens if they're exactly the same? You're going to lose out. So, and you sort of got to look at the professional press and say, right, what indications are that they are going to come down in 2 years? Not something I'm particularly convinced of. Personally, and this is just a personal sort of view, I think that will be where we are at the moment. I don't think there'll be an awful lot difference in 2 years' time. 3-4 years' time, I think that it may change, and the outlook for looking a little bit further on. So, and that's what I'm saying, clients of mine. I mean, because people are now coming to me for the first time in a long time saying, I want a 2-year rate because rates are going to come down, and I don't want to miss out. Well, just take some advice on it. That's what I would say.
Yeah, absolutely. And of course, we have to say it, but anything that we discuss on this podcast should never constitute financial advice. It's just people, ourselves, sharing our opinions on what we see in the market. And it's interesting because Simon P and I talked about this recently. And, for the first time in the last couple of years, I've just been selecting 5-year rates. And that is just because my typical disposition was I don't mind looking at new things in a short period of time. So I used to pick 2 years, but now I'm actually, to use corporate terminology, looking at longer time horizons. So whether or not the rates go down in 2 years or not is there. And I could make those savings if I had a 2-year. But with a 5-year fix, what that means, particularly in a property business, is that I can just forecast things for longer. I can model out my income, my expenses, and start building the revenue model based on that. And yes, some people would argue, well, hey, if the rates drops, then you're missing out on a lot of income. But for me, it's about continuity and predictability, which is tough in property, as we know. But I guess as we're talking about swap rates, Simon, that's leading us neatly into the kind of the meat and potatoes of the podcast, which is really talking about where we're at with mortgage products at the moment, and for some of those products, how they differ to when you were last on a few weeks back.
Yeah, I mean it's probably the number one factor when I'm talking to anybody at the moment. I think to point out, let's have some good news. I think that's there is some out there. I mean, certainly from a buy-to-let or limited company side of things, limited company buy-to-lets, HMO side, rates haven't really changed an awful lot. Haven't really changed pretty much last sort of 4 or 5 months. You're always looking at 75% LTV as a maximum anyway. 2-year rates at just over 5%, 5.09 is the best on the market. And then 5-year rates, 5.35. Okay, that's the lowest. I mean, again, as you said, Stuart, you've got to meet criteria on these things, but I'm just looking at the lowest rates, what's out there on the market from a sort of a mainstream lender point of view.
This is the only silver lining that I've been saying to people recently. As an HMO borrower myself, obviously for the last several years, most of my rates have always been, as you know, basically 5.29 from Reliance.
Yeah.
So
absolutely.
For me, when people say, how are the rates affecting you? Okay, do you know what? At the moment, not a lot.
No, absolutely. Which is crazy, isn't it, really? Because we've been talking about this for a few years, and they've always been around that sort of figure. And then you marry that up. HMO slightly high. It's still that cheapest rate, 5.29. So it's still there. That's been there for quite some time, not really changing. So obviously the lenders are quite comfortable with that because they're there. They're getting that sort of is. The standard buy-to-let, a little bit different. Cheapest 2-year rate is 5.76, which is a bit higher. Cheapest 5-year, 5.29. But we're certainly seeing a downturn in sort of standard buy-to-let, certainly standard buy-to-let purchases.
And is that residential or a limited code?
That's just standard, personal buy-to-let. Yeah. You then move that into the residential world, 75% LTV on a 2-year fixed, 5.4. So you're getting over and above buy-to-let figures. Wow. I mean, that's something in all my time, I don't think my memory goes with age, I'm afraid, gents, but I don't think in all of my years that I've ever seen that before, where residential rates are over and above, or limited company HMO buy-to-let, because they've always been the most expensive. So that's kind of where they are. And that's a big jump. If we look back when we were talking about this last month, the cheapest 2-year, 4.5. So nearly 1% more. Big jump. So if that's an indication of where the banks are going, do we think they're going to keep going up? No, not at the moment. Not unless there's another Bank of England base rate increase, which is likely, possible, whatever your views are. I think I would go on likely. And so we'll probably see that. I mean, tracker rates, people are not looking at tracker rates anymore. They're slightly lower, but do you want to take the risk? Probably not if you're a residential owner, unless you've got something quirky you want to do with it. 5-year rates, about, like I said, about 0.5% lower. So you can get a 5%, you can get something just below the 5% mark if you want to go for 5-year fixed. So that's slightly better. Interesting. 95% mortgages came back on the market, but were around a lot more 6 months ago, 3 months ago, really. Now, not so much. If you want a 2-year 95% mortgage, 6.39. So that's going up. And an interesting, where people were sitting on standard variable rate for quite a while. I just had a one standard variable rate from a specialist lender this week at, to get my figures right, I think it was 11.39 on standard variable.
Ouch.
Not something you want to sit on for too long.
No. So we've thrown lots of numbers out there, and as we've gone through that, I wonder if perhaps we could have a sort of recap, and just to clarify which numbers relate to what things. So if we start with residential home purchasing, so this is not buy to let, so not our core listeners, but just for reference, what would be a typical 2-year and a 5-year fix?
Right, a home mover. So if you're moving house, 2-year, 75. Remember, the higher the borrowing, the higher the rate. But let's just presume it goes to 75%. It's just for numbers. Your 2-year rates, residential, you're looking at 5.4%. For a 5-year rate, if you prefer, 4.94.
Okay, cool. Moving on then to simple buy-to-let, but in a personal name. What are we looking at there?
Purchase buy-to-let. They're the same, purchase and remortgage, actually. In a personal name, 2-year, 5.76, and a 5-year, 5.29.
Fantastic. Okay. And then sort of stepping up again then. So we're now moving into limited company, and then been starting with buy-to-let again. What are we looking at there?
Right. Limited company, buy-to-let, 2-year, 5.09, and 5-year, 5.35.
Okay. And then I think the final step on our ladder for today, at least, is HMO borrowing. So again, in a limited company, but HMO.
HMO, 2-year, 5.29, and 5-year, 5.6, both the same on the purchase and remortgage. So they've both on the limited company buy-to-lets and HMO. They haven't really changed very much.
No. It's really, really interesting that they haven't sort of drifted up with everything else. All of the rates are sort of compacted. So whereas before you had sort of a full range from residentials being just 1% or 2 up to HMOs being 5-ish, but now everything is up there around the sort of 4 or 5 mark. So, yeah, very interesting.
The only other question I had for you, Simon, was on HMO, because typically when I started out, we were looking at 85% loan to values. And now, if I had the option, I wouldn't go for those now just because of the leverage and obviously the rates. But typically, and you mentioned sort of 75%, can you get up as high as 85 anymore, do you think? Or is kind of like 80 the ceiling?
Yeah, you certainly can. Where the appetite for it at the moment, I've got to say, isn't really there. I think people take the same view as you. Do you really want to gear up, leverage up that high? But yeah, rates are certainly going to be higher. I don't have them to hand, but yeah, it's not something. Interesting enough, they were quite popular year plus ago, I would say now, but now people are just don't seem to be looking at 85% rates, and that may be because they're just not that popular.
Yeah. And I mean, I had a brief look actually. I mean, 2 years is somewhere around over 6%. So either 6.5, 5-year, actually very, very similar for those. So again, like you say, I think most of us are just sort of stepping back from that amount of leverage for obvious reasons.
Yeah. I think the good, I mean, what will always work with HMOs and generally is the stress testing. So the stress testing on something like that, it will work, and you can still borrow up to the 85%. So that's the really good. That's the attractive thing about HMO products, because the rental income is so good. You can always borrow generally what you want, and I think that's it. I mean, I've had a quick look here, and I've got one at the moment, 7.5 at 85%. So that's that's kind of where you're going for. They're not as attractive. Lenders of it are clearly not wanting to advertise and wanting to promote them at the moment. Not an inquiry I've had for quite some time.
I mean, just direct experience on this from my side is just obviously, particularly with 85%, when I look at the portfolio, it's the equity, that causes the challenge, because, having a big portfolio is quite nice, it's a good 7-figure portfolio. But when I look at the equity, I'm like, that concerns me when I think about interest rates. So I just wanted to, share direct experience of why that is an issue, because clearly if several years ago we'd gone for 75 or 80, I feel much more confident having greater equity in the business, should things transpire in the market and, as we're seeing prices flatten out, plateau, and possibly decline, then we've got that equity in the portfolio to work with. But actually with a high leverage portfolio, that becomes a little bit more dicey, certainly in my experience. Squeaky bum time, as Alex Ferguson used to call it.
Yeah, 100%. I think that's something but my feeling is we will be talking about the latter part of the year. It will be interesting to see how house prices go. You're right. If you started off with 25% equity, you'd like to think that you have enough of a buffer to ride out any storm we are possibly expecting or we will have. And I think that's we're only just seeing, I think the thing is we're only just starting to see what these higher interest rates, the issues they're causing. Because people are still sitting on 5-year rates. They're still in the middle. They've only had them for a year or 2 years or 3 years. So they're not expiring for another 2 or 3 years. So it isn't a problem. It's someone else's problem at the moment. But believe you me, when it comes to that, when it's, I'm contacting clients 6 months in advance and saying, here you go, this is what you're expecting. It is a damn shock. It really is. And for some people, they're just saying, well, I can't afford it. I literally can't afford it. And if you are in the buy-to-let market and you have a small portfolio of 2 or 3 small buy-to-lets, and your rate is then going from, we were doing, on a personal name of 2% up to 6.5%, well, you might be able to put your rent up by £25-30 a month. You can't treble it. And if you are geared up to 75% at that point, people are concerned, and they're not then going to be ploughing in hundreds, thousands of pounds in each month to keep that portfolio. They'll just get rid of the property. So in that case, then what happens? They're then distressed sellers, and then the property goes cheap because it's not that people were then, I see it quite often where people, if it's your own residential property, you're quite guarded, and if someone's told you it's worth 500,000, you want 550. If it's a buy-to-let and you're told it's worth 500, you'll probably take 450. I see it all the time. It's quite strange, really. But because you in the back of your mind, you think, all right, it's a business. I don't need it. I just want it off. I want the money. And then that will definitely, from the way I see it, that will have a knock-on effect to the market going forward. We need more properties on the market without a shadow of a doubt. But do we need the distressed sales, which are going to be coming over the next few years? It's kind of watch this space, because I think there's going to be a lot to talk about.
Yeah, I think another factor that's sort of pushing people as well is where presumably they can't even get remortgages because the stress rates just don't allow them to get it at all without putting new money in, which they don't want to or don't have or whatever. And on stress rates, what should people expect at the moment in terms of both the actual stress rate percentage that banks are using in different scenarios, and also the rental cover requirements on top of that banks are using?
That's a really good question, Simon, because at the moment, the stress testing is tough. Certainly if you're doing it in a sole name, it's really, really, really tricky. Stress testing, for the listeners, you can jump online, you can find all sorts of different lenders who will offer different types of stress tests. But I've just put in, to give you guys and the listeners an idea, your say average, but certainly in the Southeast, a £350,000 buy-to-let purchase in a sole name. I would guess £1,500 a month rental would be probably a fair figure on that. The most you can borrow is just over 200,000. So you have to put in £150,000. And of course, what do? The lender will say, yes, you can have that just over 200,000, but you're going to on a higher rate, and we're also going to charge you a 3% fee. So we'll give you that money, and then what they will then do is you can come down slightly. If you want to borrow slightly less, we'll reduce the fee down. So they're out there. The stress testing is what I would say is difficult in a sole name at the moment.
Focusing on sort of sole name to start with, then what would be a typical percentage stress test rate? Is it sort of, I think I've seen some that are around 2% above lending rate. Is it that sort of level, or?
Yeah, on this, it's usually goes. There's a nominal rate there. The lender will use, and then it's somewhere, or it'll be usually something like pay rate plus 2% or minimum 7%. They will give you some of that. They cover themselves well and truly. That's without a shadow of a doubt. And it's the only inquiries really I'm getting at the moment are limited company buy-to-lets and HMOs to a degree. But I think more on the HMO side is that it's just a lack of property.
Yeah. On the sort of personal name versus limited company, am I right in thinking that one of the big differences there is the rental cover percentage requirement? So again, I don't want to put words in your mouth or numbers in your mouth, but I think some of the ones I've seen are 125% on 5-year products in a limited company versus 145% for 5-year products in personal name. Is that still holding true?
Yes, very much so. If you look at, just use one of the main buy-to-let players in the market, they use 165% in a sole name at the moment, and then 130% as limited company. Vast difference. Vast difference. So you can clearly borrow a lot more. If I then put the figures in again for same product, limited company, you can borrow another £35,000. So using the same figures, but putting it in a limited company name, that's going to be for most people, that's going to be the difference between buying it and not buying it if you're interested in that market. So yes, a lot to be said. And again, as we said, speak to your accountant if it's something you want to do and make sure it is the correct thing for you. But at the moment, the feedback I'm getting, the feedback from accountants I'm getting, as we stand at the moment, as of this date, getting new buy-to-lets, purchasing new buy-to-lets, it seems to be the only way to go.
We're running slightly long, but just quickly, fees these days are sort of 1%, 2%, 3%, maybe even more. Are you seeing much sort of change from a month or so ago on the fees front, or is it just still looking pretty grim?
There's a certain difference between residential and buy-to-let. I think there always has been, really. Residential, you can, on the residential side, because the rates are going up so much, the lenders are very kindly, they are putting out some fee-free or no arrangement-free products out there. There will be a slightly higher rate, but it depends on the loan if they make it worthwhile. So residential is slightly different. Buy-to-let side, yes, you're looking at 1%, 2%, 3%, depending on what the rate is and how it fits. It really does, I would stress to anybody, is look at your particular loan size, your loan to value, and see if it makes it work. All brokers will have some analysis, and we're able to look to make sure over a 5-year period what the best product is for you, including the fee. So don't necessarily get put off by a big fee and a smaller rate or a higher rate, lower fee. Don't get attracted to one or the other. Ask to see which is the most financially viable for you over a particular period, because there are lots of options, but most lenders will give you the option of either 1%, 2%, 3%, but they're still out there, and some of them can be fairly scary.
my only comment on this before we wrap up is that, I'm guilty, I would imagine, of being quite lackadaisical in the past of just looking at mortgage products, really just looking at the monthly payment rate and or interest rate and thinking, okay, that's the one that works best with my investment property. However, I think with the introduction of fees and the percentage rates and how that works against the loan, I think it's more important than ever now to actually sit down and take the time out of the 30 minutes, an hour to punch that into a spreadsheet just to look at how those fees impact the loan. So that's my only comment on this to anyone listening, is that, do take the time. And if you don't understand it, speak with your broker. And if your broker's not Simon, still speak with your broker about it, because I think it's more important than ever to understand the implications of those fees against the long-term lending on that.
Yeah, we have, all brokers use a type of software, which is then you're able to work this out over a 2-year period, 3-year period, 5-year, 10-year, whatever you want it to be, to include all the interest, include all the fees. You can see the overall cost. Ask for that information because it does make a difference. It's very easy. We're not hiding it away. There's no need for us, the brokers, to hide it away. It's there. You can see it at any point. Most people, like you said, Stuart, most people have ignored it for years. There's no point. If we just sent it over, they go, what on earth is this? Now it's important. Rates are going up. It makes a difference. The percentage fees make a difference. Don't just look at the lowest rates and be frightened off by by fees and things. Look at the bigger picture, because it can, certainly make a difference. But speak to your broker, and they've got that information to hand.
And if you don't have a broker, or if you'd like a new broker, or to explore the possibilities of a new broker, Simon Glastonbury is available, and his contact details will be in the show notes. So please do get in touch with him. And I think we're going to finish there. So thank you very much for joining us today, Simon, and sharing all that fantastic knowledge and the latest turbulence in the market. And for everyone listening, Stuart and I will be back again next week.